Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about KE Holdings Inc. Annual Report. KE Holdings Inc. operates an integrated online and offline platform for housing transactions and services in China. The company provides a wide range of businesses and services through its 5 segments. The Existing Home Transaction Services segment offers existing home transaction services to customers. This includes buying, selling, and renting existing homes. KE Holdings also provides new home transaction services, which involves the sale and purchase of new homes. In addition to these services, the company operates a home renovation and furnishing segment that caters to customers' needs for home renovation and furnishing. The Home Rental Services segment offers rental property management and operation services, including contract and secure payment services. The Emerging and Other Services segment includes various other businesses and services provided by KE Holdings. These include Agent Cooperation Network, which fosters reciprocity among service providers, and the Dayu brand for connected brokerage stores. The company also owns other brands and offers escrow and other services to its customers. Overall, KE Holdings Inc. provides a comprehensive range of housing transaction and related services through its integrated online and offline platform. KE Holdings Inc. market capitalization of $148 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that KE Holdings Inc. holds a significant advantage in their industry. KE Holdings Inc. trades at a higher price-to-earnings ratio of 39 times and a lower price-to-book ratio of 0.65 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 46% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline can be identified through a review of the key factors that have impacted the company's financial performance. On the growth side, scale expansion has been a significant contributor, with a 62% year-over-year increase in home units under management. Enhanced profitability and increased contribution margin from new product offerings have also driven revenue growth. Additionally, higher contribution margins from Carefree, Rent Business, and growth in agency services revenue have contributed to the company's revenue expansion. On the decline side, decreases in net revenues from existing and new home transaction services have been major drivers of revenue decline. Decreases in commission revenue and accounts receivable turnover days for new home transactions have also negatively impacted revenue. Furthermore, amortization of intangible assets and declines in earnest deposits paid to real estate developers have contributed to the company's revenue decline. Interestingly, some areas of the business have remained neutral, with revenues from platform services, franchise services, and other value-added services remaining stable year-over-year. However, emerging and other services have declined by 36% year-over-year. Overall, these factors highlight the importance of scale expansion, profitability, and diversification in driving revenue growth, while also emphasizing the need to address declines in key areas such as commission revenue and accounts receivable turnover days. The company's financial performance took a significant hit in 2025 compared to the previous year. Net income plummeted by 26.8%, dropping from RMB 4,078 million in 2024 to RMB 2,991 million in 2025. This decline was accompanied by a decrease in profit margins across various categories. Gross margin fell by 3.2% from 24.6% in 2024 to 21.4% in 2025, while operating margin dropped by 1.8% from 4% to 2.2%. The net income margin also decreased from 6.8% to 5%, a decline of 0.8 percentage points. Perhaps most alarmingly, adjusted net income margin plummeted by 58.7%. Unfortunately, the provided text does not offer any specific reasons for these changes in financial performance. Despite this lack of insight, it is clear that the company faced significant challenges in 2025, resulting in a substantial decline in its bottom line and profit margins. The company's financial performance indicates a significant issue with its ability to generate positive operating cash flow. According to the provided information, the net cash provided by used in operating activities for 2025 is a negative $376,170. This suggests that the company is actually using more cash than it generates from its operations. Furthermore, the operating cash flow for 2025 is reported as minus $3,219,000, which reinforces the notion that the company is experiencing a substantial shortfall in generating positive operating cash flow. These figures collectively indicate that the company's current financial situation is characterized by negative operating cash flow, posing a challenge to its overall financial health and sustainability. The company's debt level and interest expenses have undergone some fluctuations, but the extent of these changes is not entirely clear. According to the extracted summaries, the total debt level decreased by 12.6% from RMB 65,819,191 in 2024 to RMB 57,349,991 in 2025. However, this decrease is partially offset by an increase in short-term and long-term borrowings as of December 31, 2025, which stands at RMB 390,634,000. In terms of interest expenses, there has been a slight decrease of 5519 RMB from minus 12,466 to minus 6,947. However, this change is not considered significant due to changes in market interest rates. Overall, while there have been some variations in debt levels and interest expenses, the extent of these changes is not substantial enough to be deemed significant. The company's performance across various segments has been mixed. On the positive side, existing home transaction services and new home transaction services have shown strong results. These segments have likely benefited from a growing demand for housing and a stable economy. Additionally, the home renovation and furnishing segment has also performed well, indicating that consumers are investing in their homes. On the other hand, the home rental services segment has struggled, suggesting that consumers may be opting for alternative forms of accommodation or facing financial constraints. This poor performance could be attributed to various factors, such as changes in consumer behavior, increased competition, or economic downturns. Management is signaling a positive outlook for the company's future performance. They are introducing new metrics to better reflect operational efficiency, indicating a focus on improving internal processes and productivity. Additionally, they are confident in their ability to manage cash flow effectively, with sufficient reserves to meet current and anticipated working capital needs. The company is also exploring opportunities for growth through investment or acquisition, suggesting that management is looking to expand the business's reach and capabilities. Furthermore, they expect revenues to continue being denominated in renminbi, indicating a commitment to operating within the local market and leveraging its potential for growth. Overall, these statements convey a sense of optimism and strategic planning, positioning the company for long-term success. The company has a history of rewarding its shareholders through various means. One such way is by paying dividends, which it has done consistently as mentioned in multiple pages of the report. This indicates that the company values its shareholders and is committed to sharing its profits with them. In addition to paying dividends, the company has also been actively buying back shares. The cumulative repurchase amount since September 2022 stands at a significant $2,546.5 million, demonstrating the company's confidence in its financials and desire to return value to its shareholders. That concludes the financial summary for Key Holdings Inc. Feel free to comment below, and I will be happy to answer them when possible.